Hello, everyone. Glendora Library coming at you with Money Smart Week. And you may or may not know that Money Smart Week happens in April every year. And so today we have with us Professor Paul Abbondante, who teaches finance and economics at the University of Verne. Professor, thanks so much for joining us today.
Thank you for the invitation.
Of course. So let's get right into it and begin with credit score. Okay, so what exactly is the point of a credit score? What does that number mean, and what would be a good number to have for a credit score?
Credit score is a mathematical evaluation of somebody's management of their financial affairs. And to give you a quick update, the numbers, I'm looking at the notes, the numbers go as high as 800 to 850, okay. And that's good. Then they come down. Numbers in the range of 300 to 579 are poor, and from 579 up to 669 at best is fair. What is the importance of that? Well, banks, lending organizations evaluate that for your ability to pay back a loan. Okay. The factors that affect a credit score are your payment history, then the how much, excuse me, how much do you owe, which is back to financial management. How long do you have a credit history? What kinds of credit do you have? And do you have any new credits that you keep applying for? So, okay. For example, applying for a new credit card every month is not a good idea.
Not a good idea. I don't want to do that.
No.
Yeah. Okay, great. Let's move on to investing. Now, let's say I'm 25 years old. All right, I will never pass for 25, but let's say I was, right? I might be thinking, investing, my parents do that, or middle-aged people do that. Well, is that the case? Can I invest when I'm 25? Should I think about that? And if so, how do I get started?
I recommend my students start investing as soon as they graduate from college, which means early 20s. So whether you go to college or you finish high school and start working, the sooner you start, the better. Mm-hmm. Social Security is in financial trouble, and it could easily run out of money before you retire. So my very strong suggestion is that you should plan on investing and have enough money when you retire so that you don't need Social Security. If Social Security is available when you retire, you can look at that as winning the lottery. But you cannot count on Social Security. There are people living on Social Security today, and they are struggling. Mm-hmm. Learn from their experience. The sooner you start, the easier it's going to be to build up your savings so that when you are middle-aged and 60s and 70s, you are comfortable, you're not afraid of retiring, you've provided for yourself, and you're not depending on Social Security.
Okay, so we talked about investing, and that's well and good. And so we look at terms such as stocks and bonds and mutual funds. And we hear those a million times, and I feel like people feel like they know what those are, and yet I'm not sure that people could actually come up with a definition for that. So what exactly is a stock, and what is a bond, and what are mutual funds?
Okay, those are good questions, and I hope everybody watching this learns. A stock is a share of ownership. So for example, if a company had 100 shares and you have one share, you own 1% of the company. And that's a very unrealistic example. Apple has 16 billion shares. So if you own one share, you're not a big owner. But you can make a lot of money by investing in shares. But shares means ownership. Part of that is a responsibility to vote for a board of directors. You're an owner. Now, a company could have 1 million shareholders. They cannot manage a company. So the shareholders vote for a board of directors. The board represents shareholders, and the board hires the president, the chairman, the vice presidents, and the board's responsibility is to look out for shareholders. But that doesn't take away from the individual shareholder's responsibility that you are an owner. And that's the way people make money. If you can invest in a company and do well with respect to stock price going up, you're an owner and you make a lot of money. I hope that happens. A bond is a loan. It's another form of investment. Banks make loans to companies. Companies can also issue bonds, and then investors like us can invest in bonds. It's a loan. You get paid interest twice a year. Bonds are less risky than stocks. Only good, well-managed, high credit scoring companies can issue bonds. They are a good investment for retirement. If you are very conservative, and we will talk about risk, if you are conservative, that's fine. There's nothing to say that you have to take on a lot of risk when you invest. Bonds are a less risky investment. You're lending your money to very stable companies, and you get a check twice a year. So you're a lender. You're not an owner anymore. You're a lender. A mutual fund puts together a group of investors. You and I, on an individual basis, don't have a lot of money to invest. We might be able to invest in one or two companies. If we put all our money together, we could put together a larger investment fund, and we could invest in 5 or 10 or more companies. Mutual fund industry is very well established and very sophisticated. Mutual funds are managed by full-time investment professionals. Most of us work full-time, and that means we are part-time investors. These full-time investment managers work 40, 50 hours a week looking for good investments. So you're giving your money, I should say, investing your money with professionals. Are they perfect? Of course not, but they do a pretty good job. There are thousands of mutual funds. They specialize. If you like a particular industry, for example, technology, which is very important, you can find mutual funds that specialize in technology stocks. So they put together a big fund and they'll buy shares in Apple and Google and Microsoft and so on. On an individual basis, we cannot afford that. But in a mutual fund, you end up owning shares in a lot of different companies based on your views of your investment preferences. If you're going to start out investing, and that was a good question if you're in your mid-20s, I recommend looking at mutual funds first. Look to get the help of professional managers, monitor the investment. Mutual fund shares have prices that go up and down every day, so you can monitor them easily. But that's a way to relax and not worry every night, how is my 10 shares of a company doing?
Right, over every individual, every stock. Well, that leads me to my next question. So you kind of alluded to it. So we hear the term balanced portfolio. Okay, I know what a balanced breakfast is, but what do we mean by a balanced portfolio? What the heck does that mean for investing? And as I get the lights, pardon me.
A portfolio is a group of assets, and we all have them, no matter your age. And it's not just stocks and bonds, it's your home, your car, savings account, checking account, everything you own as an asset is a portfolio. Now, a balanced portfolio refers to investing activities. A lot of people put money into their homes, and their homes have increased in value, good for them. But their homes don't generate any income. And their homes won't generate any income until they sell their homes. And there's nothing wrong with that when the time comes to retire. A balanced portfolio refers more to stocks and bonds and mutual funds. Balance means don't put all your money in one investment. Don't put all your eggs in one basket. So you have to look around and say, what kinds of investments, more than one, do I like? I'm not going to put all my money in one mutual fund or one stock. I'm going to spread it out and take advantage of spreading out the risk beyond one specific investment.
Yeah, it's timeless advice for, I think, for many things in life, that don't put all your eggs in one basket. Absolutely. So I'm going to show my age with this next question here. So what is this this newfangled Bitcoin that I keep hearing about? Is it fake money, or what's the deal with Bitcoin? What's the whole point of Bitcoin?
Bitcoin is another form of money. The money we use now is backed by the government. So it's official. You can take $1 and buy anything all over the world. Bitcoin does not have any official legal standing. It's an alternative to legal money. And it was a way to, let us say, get around government policies and provide some competition in the money industry, if we could use that word. There's nothing backing up a Bitcoin. For legal money, we have the economy of the United States, which it might not be doing so well right now, but the economy is there. The federal government is there. Federal policies are there, and we can get information about that easily. There's nothing backing up Bitcoin. So instead of financial analysis, Bitcoin values depend on psychology more than anything else. If people like it for some reason, the value goes up. If it doesn't, the value goes down. Just monitoring Bitcoins superficially on my part shows a lot of variability. In my opinion, it's too risky. I do not recommend that you get involved in it. And you're going to hear people say, I made millions of dollars in Bitcoins. Another question I have for the people who do use Bitcoins is, how do you buy stuff with it? There was some months ago, Tesla said they were going to accept Bitcoins. I don't think they do that now. Well, if you buy something at a store with money, the store can go buy other things with money. You spend money at a business, company takes that money and pays their employees. So if a business takes Bitcoin, how do they pay their employees? How do they buy their supplies? That's all unknown. It's very hard. It may come that with technology, Bitcoins become more acceptable as currency. So you could be able to buy and sell things with Bitcoin. But right now, my opinion is it's too soon, too early, and too risky.
That's so interesting. Okay, so the next topic quickly is debt. Okay, so if I'm 30 years old, I may have student loans, I may have a car loan, I may have credit card bills, I may be up to my eyeballs in debt. And if that's the case, what is the best way to start to dig out from under that? Which of those should I tackle first, or does it matter?
Well, first of all, you cannot stop paying on a loan. That's going to kill your credit score. Banks don't like that. You can say, well, I'm overdrawn. Okay, I understand that. But now there are some options to you. If you have all these different kinds of loans, you have to talk to the lenders, regardless of the kind of loan. Most of them come from banks, right? Student loan, credit card, car loan. Talk to the bank and be honest with them. They've heard this before. You're not telling them something they haven't heard before. They are more than willing to work with you. Banks want to be repaid. They don't want to take your car back. They don't want to take your home back or anything like that. Banks are in the money business. They make loans and they want to get paid. That's all they're interested in. So they will do everything they can to work with you as long as you're honest with them. Okay. Don't wait and stop paying on one loan to pay off another loan. As you see yourself getting in trouble, tell everybody. Again, they've heard it before. They will appreciate your honesty. They much prefer to hear honest information from people rather than wait for somebody to go into bankruptcy. Bankruptcy doesn't help anybody.
And so which type of debt should I pay off first, or does that matter?
I'm not sure it matters.
Okay.
I would say in general, as long as you're paying all the debt, pay off the debt with the highest interest rate first. So if it's a credit card and you're paying 20% a year on a credit card, pay that off. Don't stop paying on your other loans, but pay off the highest interest rate loan first.
Okay, thank you. Okay, simple question, not really. The simple yet not simple question, how does anyone know when they have enough money to retire?
It's a simple question with a not so simple answer. You have to look ahead. And again, we're talking to younger people here. You could be working for the next 30, 40 years. What is the economy? What is the situation going to be that far in the future? Nobody knows. But I would say this, you should plan ahead so that you could have enough money in retirement to meet your monthly expenses plus any unexpected expenses. That's easy to say and hard to do. So as an exercise, if you were to retire today, how much income would you need today to be comfortable? You don't have to be rich. You don't have to live in a mansion on the beach. But how much would you need to be comfortable today? Then, and here's the hard part, you're going to have to forecast inflation. So you're going to say, if I need $5,000 a month today, how much will I need when I retire? I'm not going to tell you, no one can tell you 30 to 40 years from now how much you're going to need. But that's a start in the way you're thinking. You want to have enough money to meet your monthly expenses at that time. Now, what should those monthly expenses be? Well, by the time you retire, you should pay off your home, pay off your car, get rid of credit card debt, student loans, and everything else. So as much as possible, you should be debt-free by the time you retire. So that way your monthly expenses are just your living expenses, not your interest expenses.
You mentioned paying off the home. If someone today or at any point is in the market for a new home, or not a new home, but just a home in general, how much should they plan on having for a down payment? How much do you need for a down payment on the purchase of a home?
Down payments are measured by percents. Banks will charge in general 10 to 20% of the home, the value of the home. Some of them go down to 5% or less. I recommend that you be very careful about that. People want to get into their own home. I understand that. But if you're going to put down 5% on the value of the home, you're getting a 95% loan. The payments are going to be very high. Now, the bank is not going to make the loan unless you have the income to pay for it. But at that rate, there's not a lot of room to make mistakes. I wish nothing bad to happen to anybody. But looking in the past, 2008, 2020, bad things happen. If, for example, you lose your job, or you have an illness, now you're not going to be able to make the home payment. So don't get yourself in over your head. The bank will help with that. But now sometimes banks get aggressive. They will make loans that they know are risky, and they know they're taking a chance, but they do it anyway. Look what happened in 2008. There were a lot of bankruptcies because banks loaned money to people who should not have bought their own homes. So banks or bank managers are just as susceptible to psychological effects as the rest of us.
Yeah, so fascinating. So putting this all together, as we almost run out of time, what would you say is the first or most important step to financial planning? Everything we talked about, just financial planning, what would you say to people is the most important step to begin with?
The first step for all of you, absolute requirement, make a budget. Look at the money you have coming in on an after-tax basis and look at your spending. And don't fantasize. Look at actual numbers. Look at bank account, credit card, ATM receipts. Save receipts from wherever you spend money. How many people spend $5 or $10 without thinking about it? It's easy to go to a teller machine, get money, spend it, and not even know that you spent it. At the end of the month, you get the bank statement. You said, I spent what? And you have to be hard on yourself. You have to look at this very carefully. And that's especially true, for example, if you get married and there's a two-income household. Now you think, oh, we got two incomes, we can spend money on anything. No, you can't. With two incomes, that's twice the trouble you can get into. So be very careful and be very accurate, and that's hard. You have to be really honest with yourself, and now you have to make hard decisions. Do I really need to spend money on these items? And in a lot of cases, the answer is no. To give you a quick example, suppose you wasted $1 a day. That's $365 a year. Even at $6 a gallon, that's 60 gallons of gas per year. At 25 miles a gallon, that's 1,500 miles of driving. So wasting $1 a day costs you about 1,500 miles of driving in a year. People don't think that way. When you do a budget, pennies count. Don't say, well, it's only $5. Be very accurate, include the pennies, and figure out where your money's going and why.
Professor Abbondante, thanks so much for joining us. A lot of great information.
Thank you.
And so Money Smart Week is in April every year. If you are looking for books or resources on budgeting, planning, investing, stocks, bonds, please visit the Glendora Library or check out our e-library anytime at www.glendoralibrary.org. Until next time.